Welcome to the Wilber and Longenbaugh podcast, where we break down tax, accounting, and financial strategies to help businesses stay compliant, profitable, and prepared. So, think about this scenario. In 2025, a massive software company hit like $8 million in revenue. They boasted a 65% profit margin, and then they quietly went bankrupt by November.
Yeah, which is just wild.
Right. And it happens because, profitability is an absolute illusion if the cash isn't actually sitting in the bank. So welcome to today's deep dive into the top bookkeeping metrics for 2026.
It really is a reality check that a lot of businesses need right now, especially with, tighter margins and all the changing tax requirements we're seeing.
Oh, yeah, and the aggressive competition this year.
Exactly. You just can't only look at top-line revenue anymore. We're unpacking how tracking the exact right metrics transforms raw financial data into, actual actionable insights, catching the small leaks before they sink the ship.
Let's start right there with cash flow because, we see so many founders obsess over profit, treating it like it's the ultimate scoreboard.
Oh, all the time.
But I always look at profit like the calories you eat, while cash flow is the oxygen in your blood. You can have a massive caloric surplus, but if you stop breathing, your organs just shut down immediately.
That's just the perfect way to look at it. You can record incredible sales, but if you're operating on net 60 terms and your clients stretch that out to, say, 90 days.
Which they always do.
Right, they always do. Then those sales are essentially meaningless oxygen that you haven't even inhaled yet. The mechanism of failure here isn't a lack of demand. It's a timing misalignment, between cash entering the system and payroll actually leaving it.
Okay, but let me push back a bit on how we actually manage that accounts receivable aging.
Yeah.
You say to watch the trend and, jump on those 60-day stragglers.
Yeah, you have to.
But if I aggressively hound my biggest anchor client for a payment on day 31, I risk losing their business entirely. How do you balance liquidity with client retention?
Well, it's a very real operational dilemma. The strategic play isn't necessarily hounding them, right? It's structural.
What do you mean by structural?
So you build a cash flow buffer by fundamentally changing your terms across the board. You negotiate net 45 or net 60 terms with your suppliers on the accounts payable side.
Oh, I see.
And then you move your smaller, newer customers to due upon receipt. You essentially use those smaller accounts to float the cash you need.
Which gives your anchor clients the grace period they expect.
Exactly. It's about managing the timing strategically so you literally never run out of oxygen.
But let's say you've got the timing completely dialed in. You still have to protect your gross profit margin. And frankly, with prices staying relatively flat this year...
While direct costs creep up.
Right. Labor and materials are just getting more expensive. So protecting that margin is getting much harder.
It is, which is why we really need to talk about expense creep. Everyone looks at major capital expenditures, but companies are actually bleeding out from micro expenses.
Like the $40 a month software subscriptions.
Yeah, exactly. The mechanism here is usually decentralized purchasing. You have department heads signing up for recurring cloud services that just bypass procurement thresholds.
Because it's under the corporate card limit, that classic trap.
Right. And because they auto-renew, nobody reviews them. Over 12 months, you have 50 of these orphan subscriptions silently eating a massive hole in your net profit.
Well, this raises a pretty terrifying point. If these expenses are just sliding under the radar, a founder might look at their dashboard, think their margins are totally fine, and, make a massive hiring decision based on a phantom surplus.
I have literally seen that exact scenario play out. I had a client who thought they had plenty of runway.
But they didn't.
Nope. It turned out a software glitch was duplicating ledger entries for their revenue. Their dashboard showed a huge surplus, but they were actually in a severe deficit.
Wow, which perfectly illustrates why bank reconciliation cannot just be an afterthought.
Not at all.
If you aren't reconciling monthly, your financial reports are literally just fiction at that point.
Precisely. The data has to mirror reality. If you wait for the yearly tax season, scramble to discover that duplicated entry.
Or that your margin shrunk 6 months ago.
Yeah, the damage is already done. Monthly reviews are just your ultimate quality control.
So bookkeeping isn't just recording history, it's reading the story the numbers are telling you while you actually still have time to change the plot.
Exactly. When you have that consistent clarity, you replace gut feelings with actual, real strategic leverage. And, as a long-term advisor, we always encourage people to check out www.mwwcpa.com to learn how to put these kinds of structural strategies into practice.
Right, absolutely. So we'll leave you with this to mull over today. If you pulled your own bank statements right now and combed through every single automated transaction, how much of that silent expense creep would you find just hiding in plain sight, slowly draining the oxygen out of your future profits?